Hello, everyone. I'm Matt Clark, research analyst for Money and Markets with your latest Bull and the Bear podcast. Remember, you can listen to the Bull and the Bear on about 20 different podcast syndicators, including Apple Podcasts, Google Podcasts, iHeartRadio, Spotify. We're working on getting on Amazon as well. That'll allow you to be able to listen to the Bull and the Bear podcast and any other audio that we put up via your connected speakers and devices. So that's kind of neat. Make sure if you are listening to us via a podcast channel, make sure you're following us. Give us a follow there. Also like us or rate us. Let us know how we're doing. We'd love to hear from you. You can also watch the Bull and the Bear podcast on our YouTube channel. Just go to youtube.com and type in Money and Markets. We've got the little green logo there. Just click that. Make sure you subscribe to the channel, and you'll be a little bell, I think, pops up there where you can actually be notified every time we release a new video, and that's a good thing if you click that, because you'll be able to get notification whenever we put out a video, actually before we put it out on our website. So you kind of get advanced information before anyone else. And if you take action based on what we talk about in the podcast or in our week ahead or in our marijuana market update, you'll be able to get that and be able to take that action much sooner than if you were to get it on moneyandmarkets.com. So make sure you get notified no matter how you listen to the Bull and the Bear or any of our other multimedia offerings, like I said, the marijuana market update or the week ahead. And if you do have any questions or you have a particular stock or sector you'd like us to cover, make sure you email us. You can email us at thebullandbear@moneyandmarkets.com. That's thebullandbear@moneyandmarkets.com. We'd love to see your feedback there as well. Now, let me move on with today's podcast. I'll try to be brief today, but what I'm covering is a complex term when you think about it, but yet it's relatively simple to understand. And what I'm talking about is stock splits. Stock splits have dominated the headlines earlier this week as Apple Incorporated and Tesla Incorporated both underwent the process of stock splits on Monday. Apple announced a 4-for-1 stock split in July, while Tesla announced a 5-for-1 split earlier in August. Now, first, let me tell you just what a stock split is. It's a fairly simple concept, but all publicly traded companies have a number of shares that are outstanding, basically the shares that they have available to sell on the market. When they announce a stock split, the company is basically increasing the number of shares that they have outstanding. They do that by issuing more shares to current stockholders. The stock split lowers the price per share by the multiple of the split. So, for example, if you have shares that were $500 before a stock split, they would go for about $125, give or take, per share on a 4-for-1 split. The math isn't exact. There's other things factored in, but you understand. You get the idea. So, for example, if you owned 100 shares of Apple and a stock split of 4-for-1 would see you now with 400 shares of the company. Your 100 shares were once valued at $500 per share, or a total value of $500,000. After the split, you would have 400 shares worth $125 a share, but your overall value would still be $500,000. So it doesn't really change if you already own the stock. It just means you own more shares. The lower price just makes the value the same. So your portfolio doesn't change at all if you already own stocks that are undergoing a stock split. Stock splits also don't really change the market capitalization of a company. The overall value really doesn't change, only the number of shares. The intent of a stock split is really pretty simple. It's to draw in smaller investors, kind of like you and I, those of us who aren't pouring millions into the stock market. And it allows us to buy a stock that is highly regarded, but was out of reach because of a high price, like Apple at $500 or like Tesla, which is closer to $2,000 prior to the split. So it makes it more advantageous for us as smaller investors to be able to buy into a stock in some way, shape, or form. It also helps a company attract more capital by getting more investors into the pool. So you're already going to have your base investors that are now seeing their shares multiply, but the value stay the same. But by lowering the price and trying to attract new investors, they are able to add capital to their business. And I'll start with Apple. It's important to know this really isn't the first time that the technology giant has announced a stock split. They've actually done it 4 other times. They did it in July of 2014, where they announced a 7-for-1 split. They did it in February of 2005, where it was a 2-for-1 split. In June of 2000, when it was a 2-for-1 split. And then the first split was back in June of 1987 when it was a 2-for-1 split. Now, history tells us a little something about previous stock splits that's kind of important to know. In all 4 instances, Apple stock actually experienced some kind of a short-term sell-off. According to hedge funds trading platform Kensho, 2 weeks after those stock splits happened, in each one of those 4 occasions, shares of the company fell an average of 5.6%. It doesn't mean the same thing's going to happen this time around, but history does have a funny way of repeating itself. As for Tesla, this will be the first stock split the company has undertaken. They announced a 5-for-1 stock split in early August and initiated that split on Monday. The difference between the 2 splits really just kind of comes down to stock valuation. Apple was trading at a little more than $500 a share when their split was initiated on Monday. That made the new price of shares around $125, $126 a share, give or take. Tesla shares, on the other hand, have more than tripled this year. They were up nearly 230% for the year leading up to the split. And even with a 5-for-1 split, Tesla shares were still priced at close to $500 a share when the market closed on Monday. So, it's still, that price point still makes it a little difficult for smaller investors to get into the stock. You can, it's certainly a lot better than $2,000, but $500 can be still high for some smaller investors who are just maybe hobbyists or new to the market or just not wanting to take that kind of risk. Now, both Apple and Tesla have experienced nice gains on Monday when the split took effect. Tesla was actually one of the leading market leaders that day. It climbed 12.5%. Apple gained 3.5% after the split. Now, of note, Tesla's jumped about 75% in the month of August and about 50% since announcing its split on August 11th. So it has been on a consistent rise, making that split value a lot higher. That's why it's more like $500 and not more in the $300 range. Now, right now, the biggest impact the stock splits had was on the Dow Jones Industrial Average. If you remember, I told you about the Dow, how the Dow had to reconstitute itself by dropping 3 companies and adding 3 new ones because of the index's exposure to tech. And that index, that exposure rather, was reduced pretty significantly when Apple's price dropped with the split, because you see the Dow is based on price. So when a company within the Dow lowers its price by a stock split, that means their percentage in certain sectors it changes quite a bit, and this happened in tech. If you missed that video, I'd encourage you to go check that out on our YouTube channel, or you can find the podcast via our podcast channels. Now, as for the share prices of Apple and Tesla, both rose in the aftermath of the split, like I said, and that's mainly because the split did exactly what it was supposed to do: draw in more investors. As for the future of those stock prices, there's another factor to consider. Overall market conditions are going to play a big role in determining what happens to Apple and Tesla. If you look back at 2014, Apple shares actually jumped around 35% in the next 12 months. Even though they had an initial drop-off, they still rebounded nicely in 2014. However, in 2000, the tech bubble popped, and Apple lost about 60% of its share price after its 2000 split. So it's one thing to consider. Another factor that you have to kind of throw into the mix here is fractional shares. This is where brokerages allow you to buy a fraction of a share rather than a whole share. It's another way to entice investors that just don't have thousands upon thousands or millions of dollars to put in the market. Maybe you want to spend $5 on Apple. Well, that'll buy you about 0.02 shares of Apple. It's still owning Apple. You'll still experience gains. They just won't be nearly as much. The intent here is, again, like I said, to help smaller investors buy into companies like Apple, Tesla, Microsoft, but not spend hundreds of dollars to buy just one share. You can spend about $1 if you want. Fractional share buying has become really popular, and more brokerages are starting to offer them. It's led to market analysts to suggest that stock splits really don't matter because you can still spend less and own a part of a company. Now, I kind of disagree with that, because $1 will buy you a higher fraction of Apple shares now as opposed to if it were $500. So if you're only going to spend $2 when the stock's at $500, your fractional share is much, much less than what it is when it's $125, $126, $127. I think investors are still going to pile into Apple and Tesla despite the popularity of fractional shares. In fact, it might actually draw in more fractional share buyers because of the lower price to get more of a share. Now, I took a look at Money Market's chief investment strategist, Adam O'Dell's Green Zone rating system, and looked at both Apple and Tesla. And right now, Apple rates a 74 overall. And that means we're bullish on the stock. we're not strong bullish, but we're bullish. We can see Apple outperforming the market about 2 times over the next 12 months. It scores a 95 on quality, a 92 on volatility, and an 85 on growth. Tesla, on the other hand, ranks a 42 overall. It means we're pretty neutral on the stock. We see Tesla performing about in line with the rest of the market over the next year. It has strength on momentum. It ranks in 91. And it also has strength in growth, where it ranks in 81. But it takes a hit on value because it is still a wildly overvalued stock, even with the split. It rates about a 3, and its size, it's become a massive company, and that score is a 0.02, which is not great when you're looking at size. And as you know, Adam likes to talk about this, and I agree that smaller companies tend to provide you with much more, I want to say, explosive gains than a larger company will. So I would say that Apple, if you don't already own shares, it would be worth your time to take a look. Tesla, a little bit different animal, though. The company recently said it was going to sell another $5 billion worth of shares to raise capital. You can't ignore its momentum, but I would be cautious. So that's what I really have on stock splits, and more specifically on Tesla and Apple today. Make sure you check out our YouTube channel. Like I said, go over to youtube.com, search Money in Markets. We've got the green logo. Be sure to subscribe and click the little notification bell so you get notified every time we post a new video. If you want to listen to The Bull and the Bear, you can do that on your favorite podcast syndicator like Apple Podcasts, Google Podcasts. We're also on Spotify, iHeartRadio, working on getting on Amazon as well. Subscribe, and if you have the option, get alerted every time a new podcast is released. You get a little notification on your tablet or on your phone or however you get it. Say we've got a new podcast open. You can listen to it at your leisure, but you'll get that first before we actually put it out on moneyinmarkets.com. If you do have a question about a particular stock or sector you'd like us to take a look at, make sure you email us at thebullandbear@moneyinmarkets.com. We absolutely love to see feedback. We get a lot of it for our marijuana markets update, and I'd love to see that kind of feedback for the Bull and the Bear. We get a lot of great feedback from you guys. Love hearing what you have to say about either what we're doing or what you'd like us to talk about. Just keep that coming. We'd love to see that. Coming up on Friday, Money Markets Chief Investment Strategist Adam O'Dell and contributor Charles Sizemore will join me. We'll dive into a couple stocks, let you know whether they're ones to buy, whether they're ones you want to stay away from. But you want to make sure you stay tuned for that. Until then, this is Money Markets research analyst and host of The Bull and the Bear, Matt Clark, wishing you safe trading.